Good morning, everybody. This is David Berkowitz, Chief Investment Officer at ValueAligned Partners. I'm going to give you an update on where the ValueAligned Partners funds and model portfolio stand as of Friday, July 10th. First, through the first half of the year, ending June 30th, the ValueAligned fund, our hedge fund, was up 3.3%, including all fees and expenses. Other stock hedge funds were up 2.1%. The ValueAligned model portfolio, available on Folio Institutional Platform, was up 4.8%, and the S&P 500 index was up 1.3%, including dividends reinvested into the index. 10 days later, the hedge fund is up 4.2% year-to-date. Other stock hedge funds are 1.7% year-to-date. The ValueAligned model portfolio is up 6.3% year-to-date. And the S&P 500 index is up 2%. Stocks are up a bit for the year so far, but they're only up about 2% in the United States, about 4% internationally, 3% worldwide. Treasuries, U.S. Treasuries, are yielding zero. That is, the total return is zero for the year so far. Real estate, last year's winner, is down 4%. And commodities in general are down 2%, and industrial metals, a good indicator of economic activity, especially in China, is down 9.2% for the year. You can see better here, underneath here, you see the key commodities. Gold is down 2%, crude oil is down 5.5% for the year, copper is down 8% for the year, natural gas is down 8%, and lumber is down 14% for the year. Down here we have the Hayes valuation or tactical allocation model, and we can see that it's still recommending only 80% maximum exposure to equities. And the culprit here, the reason why the model tells us to be cautious, is because psychology, or what I call sentiment, is monetary and valuation are holding up the bull market. And you can see that valuation, only relative valuation, is really the one that's working. You can see the forward earnings yield of the S&P 500 is 6.1%, and the 10-year Treasury note is only 2.3%. But on an absolute basis, if you use a great model, the ValueAligned model, which has been the ValueAligned, not aligned, but aligned, has been a great model to measure the current over or undervaluation of the stock market. The 5-year annualized return is estimated for appreciation potential is estimated to be only 7%. That's a very, very low number, and it shows that on an absolute basis the stock market is overvalued. But because Treasury note yields are 2.3%, so far artificially deflated because of monetary policy, that is what's holding up the market. Your money is being treated best with the 6.1% forward earnings yield, and the money is being treated best in stocks, therefore money is flowing into stocks. On a very short-term basis, the indicator that we have been using throughout the last 18 months to tell us when to invest new money, or when we think that the market is oversold, so we should invest some money, is this indicator, the S&P 500 percent of stocks that are trading above their 50-day moving average. You can see when it gets down below 30, as it did last October, as it did in August of last year, and as it just did here at the end of June, and then just again at the middle of last week, was a good time to invest new money. So what we did was, in the ValueAligned portfolio, we invested new money. Some of our clients had over the 20% recommended allocation. We took that money and we invested it into the ValueAligned portfolio, and you can see that was a good move, as we had a good day on Thursday, Friday, and looks like the market's going to open up pretty good today on Monday. Now, the economy itself, the U.S. economy, seems to be getting better versus expectations, which means that we do have some rising expectations for economic growth, which eventually translates into rising expectations for earnings growth. And that is a welcome news because earnings growth has slowed down dramatically for the stocks. But it looks like the reason for that was because we had, since the end of last year, we had falling economic growth expectations all the way till sometime in March, and then we had a slowly climbing, rising economic expectations. In other words, the economic expectations, that the economic data that has been coming out has been above the consensus estimates of all the economists on Wall Street that have been predicting it. So that's good news. We have rising expectations. With rising expectations, we usually have a rising stock market coincident in the short term with that. The thing that we've all been focused on for way too long, in my opinion, has been Greece's debt and Greece, whether they're going to default on their debt, which they already did, whether they're going to get a bailout from Germany and the rest of the Euro crew, or whether they're going to exit the Eurozone, thereby making the Eurozone project itself up for grabs. Here's something that we discovered that shows that the upper hand in all these negotiations, no matter what Prime Minister Tsipras has done, was always with Germany and the central bank and the IMF. And the reason for that is because the government entities comprise over 75%. In other words, governments that can own loans till maturity. They don't have to worry about mark to market. They don't have to worry about anything, but they are the best holders, the best institutions to hold other person's debt, because there's no requirement that they do anything with it. There's no requirement that they get paid even. So the government entities comprise over 75% of the liabilities of Greece, whereas back in 2009, and then when we had the original Greece crisis in 2011, the private sector banks and the private sector in general owned 80% of Greece's liabilities or Greece's debt. That's why that was a big deal. But over that period of time, the central government and the governments of Europe have slowly been reassuring their banking system by making sure that the Greek debt that was probably never going to get paid back was going to be in the hands of the governments and not the institutions or the banks that could pose great risk to the world financial system. So over the weekend, it looks like the Greeks finally acquiesced to whatever the demands were from Germany, and it looks like they have some kind of deal as long as there's legislation that's passed by Wednesday in the Greek Parliament. Markets this morning before the opening look like they believe that we finally have a deal. Larry Kudlow has been very vocal about this, and he says that Greece doesn't need an IMF debt plan, a restructuring of debt. What Greece needs is a growth plan. And of course, this is any company, any government should follow the same sort of advice. They should sell every state-run company, make it private. In other words, privatize the large Greek government's intervention into the private sector, and they should slash tax rates. Maybe make one tax rate, make it very simple, and that's so the great Greek business people that are in a diaspora all throughout the world, that all have left Greece because of the ridiculous taxation there, that they'll come back and invest back in the country as long as it's friendly to them. And if they do that, that could really ignite an economic boom in Greece. Unfortunately, the plan that they just agreed to last night has none of that. And then, of course, the other thing that everybody's worried about is that the Shanghai stock market was in a bubble. It now burst. And we're going to all worry about that because China's certainly a lot bigger and a more important engine of world growth than is Greece. And the stock market there looks like it has cracked. At one point, it risen over 150% from its year-ago lows, and then it got to be down 33%. But over the last 3 days, it looks like the government interventions, what some people have called on the street buy stocks or die, because the central government basically is telling everybody to buy stocks, or telling the state-run businesses to buy stocks, or everybody buy stocks or else. Not a great way to participate. Not a market that I would like to participate in. There's no way to value the companies. No way to understand the momentum that's created by the government intervention policies. No way to know when things are going to burst. So we're going to stay out of the Shanghai stock market for a while. But I just want everybody to understand China's not collapsing by any stretch of the imagination. The stock market is collapsing, or was collapsing, and that's because so many people ran in. They borrowed money to buy stocks. Now they saw that it was going down and they all rushed to get out. It's a classic scenario of boom and bust. But China's economy, most notably its finances, are just fine, thank you. And it's very stable. So what's happening in the stock market is really just China trying to cope with prosperity. You got some people that can play the stock market because they have enough money. They want to play the stock market, and they got to figure out what the rules of the road are going to be, and they're tinkering around the edges. But you notice that Chinese currency, the Chinese yuan, versus its foreign exchange reserves, mostly dollars and euros, and yen, have stayed very stable over the last 3 or 4 years, right up here. And you can see that's after the huge growth from 2004 on. You can see that the reserves, foreign currency reserves, have gone up just like the currency has gone up. So they've done a very good job, despite all the rhetoric out of our Congress that China is manipulating its currency. You can see that they've done a pretty good job of making their currency rise along with the reserves that they had. They've stopped for the time being of increasing stronger a currency. They've stopped that for the time being because their foreign reserves have sort of also stopped going up, but at a very, very strong level. So China's done a good job of that. The whole idea of manipulating currency, they really ought to stop calling for that, because what they're really calling for is a weaker dollar. I wish people would understand that. I told everybody that 10 years ago, and I still think it. The more you tell us that China is manipulating its currency, the more you're telling the world that you want a weaker dollar, and that is never a good sign, especially since the dollar itself gives us a whole bunch of privileges. So I would caution all our leaders from going too far with the currency manipulating. So all these things are going around. They're all unpredictable. We haven't even mentioned what's going on in the Middle East. We haven't even mentioned geopolitics, but they're swirling all around. Nobody knows what's going on. A lot of you have written to me asking me, what do we do? Are we protected? And things like that. So what I say is let the wind blow any direction, from any direction that it wants to. The fact is that we don't react to everything like that. We know that there's always going to be exogenous events completely out of our control, so we have to focus on things that we can control, things that we know that we can control, that have worked in the past and that have always worked to get us through to meet our plan and our goal. So ask yourself, are your financial decisions, at least, are your financial decisions and emotions based on a metaphorical finger held up to test which way the wind's blowing? If that's the case, then we need to talk very soon. Because your investment plan should always have flexibility to accommodate any unexpected events. And what I mean by that is, when we're investors, as most of our clients are, when we want to invest, we like unexpected events that are going to temporarily cause a decline in prices far from what the fair values would be under normal circumstances. So we can buy at very discounted prices. So we look at that as opportunity. We don't look at that as something scary, and we want to make sure that our process has the flexibility built into it that we'll have some cash when it's time for those unexpected events. So we always know where we want to go. We know what our goals are. We know what our plans are. And we know what we can and can't control. And we do our best to stay on track with the things we can control. And then when things that we can't control happen, we are flexible enough to change or accommodate. And all the other stuff is predictable, boring sequel to all the other financial pornography that fills a 24-hour news cycle. That 24-hour news cycle is something that, unless it's your job, I urge you, to pay just as much attention to it as you would in your job under normal circumstances, and don't pay any more attention to it simply because you have an investment plan or you have investments in the stock market. Nothing is going to change. Nothing we're going to do is going to change. We are the ones that worry about all this stuff. You don't need to, as long as you have a goal, a direction, and a plan. And that's it for today. Stocks of good companies are always what we're looking for. We're still holding 20% cash in the funds and in the portfolio. We're monitoring price versus value, which means that we can't wait till we find some prices that are discounted to what we think the value's worth, and we're going to pour money into those stocks. And if the stock market, remember, is just supported right now by monetary policy, that zero short-term interest rates is really what's holding up relative valuation where money is coming into the stock market. So we got to be very careful when that goes away to monitor how flows change and how companies do. Until next time, have a wonderful week, and we'll talk to you soon. Bye-bye.